Hi, I'm Jim Sinegal, and welcome to the Fergasso video blog. Over the last few weeks, we've gotten a lot of questions about the implications of the 2024 election and the big wins for Donald Trump and the Republican Party. Now that the dust is settled, we'd like to provide a few of our initial observations and key takeaways for the year ahead. We'll start out by looking at the stock market. Although the economy and the S&P 500 performed fairly well under Joe Biden, consumer confidence dwindled in the second half of his term as inflation took a toll on the average household. Once the election results were announced, stocks rose a bit, indicating that there's some degree of economic optimism over a second Donald Trump presidency. But we don't want to read too much into this at the moment because the most important difference as the stock market is concerned relates to corporate tax rates. Trump has proposed decreasing the federal corporate rate again to 15%, while Kamala Harris had planned an increase to 28%. Very simply, companies would earn more under Trump than Harris. Extremely straightforward. Digging a bit deeper into sector performance, deregulation is a big theme traditionally associated with Republican leadership. Financial stocks, for instance, jumped in the immediate aftermath of the election, particularly consumer lenders like credit card companies. Fewer restrictions on lending would certainly benefit such firms, but I'll come back to that in a bit. Energy stocks have also done well. Donald Trump promised increased drilling activity and less stringent environmental regulations, which should lead to both more production and higher margins for energy companies. But not all the performance has come from regulated sectors. Other cyclical stocks, like those in the industrial sector, have also done well since the election. So we can assume there's some economic optimism baked into the market as well. That said, the story is not as clear-cut as it would have been in past elections. Though Republicans are generally seen as pro-business, Trump has attacked big tech and media firms in the past. I talked about the initial pop in financials, but there's also been talk of capping credit card rates at 10%, about half the current average. He's actually gotten the support of people like Bernie Sanders on this proposal. We also have the cabinet nomination of Robert F. Kennedy Jr., which certainly does not bode well for big pharma or the established healthcare system. Healthcare has been the worst performing sector over the past month. In contrast to the generally laissez-faire Republican regimes of the past, the second Trump administration is likely to be far more unpredictable. Turning away from stocks for a moment, we also think the bond market provides a lot of useful information. In contrast to stocks, treasuries have fallen since the election. The first reason for that is that deficits increased under the first Trump presidency, and they could do so again if taxes are cut further, as I discussed earlier. One could argue that a combination of budget cuts and higher economic growth will offset that reduced revenue, but that's far from certain. That's not the only potentially inflationary proposal of the coming term. We also have the prospect of tariffs again, which would force Americans to pay more for products, whether it's for heavily taxed imports or more expensive domestically produced goods. On the other hand, Trump has used tariffs as a negotiating factor in the past, so a lot depends on how our trading partners react to the threat. Other proposals, like a crackdown on immigration, have more straightforward repercussions. It's estimated that up to half of all U.S. farm workers are undocumented immigrants, and a reduction in that cheap farm labor would undoubtedly have price implications for the food that we eat. But one final point that I'd like to make on negotiations is we have to remember that Donald Trump is the author of The Art of the Deal, and we know that extreme positions and proposals are part of his style. Now that he has the support of all three branches of government, his initial gambits may be even bolder than they have been in the past. So we should be wary of overreacting to news as it comes out. And to conclude by reiterating that the global economy is extremely complex and that the presidency is just one of hundreds of factors that affect market performance. Overall, we'd expect this administration's pro-business, pro-growth policies to be somewhat balanced by continued inflationary risks and generally less predictable actions than we saw over the last 4 years and even Trump's first term. But all of that still stands against the backdrop of technological advancements like AI, long-term demographic trends, and the normal business cycle. Thank you for watching this video today, and we'd encourage you to reach out to one of our financial advisors or a member of our portfolio management team with any feedback or additional questions you might have. Thanks again for watching.